Hello and welcome to my channel. In this video, I will discuss a small section of Warren Buffett's annual shareholder letter of 2019. In this letter, Warren Buffett discusses about the power of retained earnings. In the first section, Buffett says that in 1924, an economist named Edgar Lawrence Smith wrote about a novel idea in his book, Common Stocks Are Long-Term Investments, which was later supported by John Maynard Keynes. The idea was that well-managed companies retain and reinvest a part of the profits earned and not necessarily distribute all of their profits to shareholders. The reinvestment will increase the value of the business over time and will result in creation of value for shareholders due to the effect of compounding. Although the idea of retained earnings, reinvestment and compound interest are well understood today, but prior to the theory proposed by Smith, common stocks were predominantly considered as object of speculation. The 1924 book by Mr. Smith changed the perspective in investment world. In the next section, Buffett mentions how Berkshire treats its profits from accounting perspective and from investment perspective. Buffett mentions that a part of the profit that Berkshire generates is reinvested either in the existing companies that Berkshire owns or it is invested in new companies. He mentions three criteria for selection of a new company. The new company must be earning good return on invested capital, must have able and honest management, and the purchase price of the company should be sensible. Thereafter, Buffett talks about the accounting of retained earnings at Berkshire. Buffett distinguishes between businesses that Berkshire owns a controlling stake, that is, greater than 50% ownership, and businesses where Berkshire owns a non-controlling stake, that is, less than 50% ownership. He says that for companies where Berkshire has a controlling stake, it includes all of the retained earnings of these companies in Berkshire's operating earnings, whereas for companies where Berkshire has a non-controlling stake, it only includes the dividend received from these companies as its own operating earnings. Thereafter, Buffett lists the total dividend received and retained earnings of the 10 largest non-controlling holdings of Berkshire Hathaway in the year 2019. For these 10 companies, Berkshire will only include $3.7 billion of dividend that it received from these companies into its operating income, whereas $8.3 billion of retained earnings of these companies will not be included in the operating income of Berkshire Hathaway. Buffett says that although the retained earnings of these companies is not directly included in Berkshire's operating income, it will eventually reflect in Berkshire's balance sheet through the capital gains when the value of underlying business increases due to reinvestment of the profits. Buffett says that the reflection of the retained earnings will not be exactly linear and will be as volatile as the market is. In summary, Buffett says that Mr. Smith was right in saying that retaining and reinvesting a part of profits earned would eventually increase the value of the stock due to growth resulting from the compounding of the reinvested capital.